Good morning. It is March 10th, 2025. It is 9 a.m. Eastern. It looks like the market is going to open in the negative, deep in the negative. The Nasdaq futures are down 1.7, S&P is down 1.43. It's a pretty red day that we're going to open to. We've been in about 30 days of a lot of volatility where stocks are, especially in some areas, are really selling off and bringing down stock prices on stocks that have been doing really well for 2 years. So let's not complain too loud. But this past week, the NASDAQ was down 2.71, and Friday's action was pretty eye-opening. We had a market that uh, rose at the beginning of the day, really sold off. I mean, it went down pretty substantially from its high. Intraday, this is intraday, and then it rose real nicely and it closed up. So you look at that volatility, you're like, geez, there's a lot of fear out there. So we definitely are dealing with a certain amount of fear where people are, investors are thinking, what's going to happen? Are we going to have good news this week, bad news? And are we going to see a further sell off of stocks? Now, me, I just look at the situation and I don't see a big positive. I guess if you think about a lot of the concern is around tariffs and the collateral damage that tariffs can cause the economy. Is it going to push us into a recession? Is it going to slow down the economy for especially some industries? Are other countries going to retaliate against some of our, best companies in the U.S.? All those questions are out there. So the removal of that concern could cause the market to go up. Wouldn't disagree with that. But I don't count that as a positive catalyst. It's kind of, it's a removal of a risk. A positive catalyst is the economy is booming. Positive catalyst is businesses are making a lot more money. There is a big move in the economy from one paradigm to the next, and it's causing a lot of value for particular industries. So I'm not expecting, a big giant catalyst in 2025. The catalyst that had been making the market go for a while was AI. Oh man, AI is just going to be so cool. And I'll joke around for a moment. I was doing laundry this morning. I put in a load of laundry and it's now in the dryer. And I'm like, well, this AI is promising robots that are supposed to do all my domestic chores. Well, when am I going to get my robot? So I don't have to do laundry, do the dishes, all the other stuff. But I'm going to stop kidding now. I think AI is going to take a while, especially the physical AI where you have robots and so forth, available to everyone. The autonomous cars, right, where you have robotaxi, that's taken a long time, even though they've been working on it for like 20 years. It just takes a long time. That was the last big positive catalyst that I can count. And that catalyst has then created the data center build out because, hey, AI is so big, it's going to be so popular that we're going to have a big build out. And both the AI story has gotten old because we didn't really see any big, uh, killer app or killer experience. I think the ChatGPT shininess has kind of gotten a little dull from that shiny object. I don't hear about too many ChatGPT stories anymore. Seems like there's 20 like products on the marketplace, and I don't know that one's overly exciting over the other. So no positive catalyst is out there. So I think we're going to probably trade a little sideways for a while. And right now we're definitely going to open to the negative. It might open up some opportunities. because as we look at the stock market, right, it's a voting machine in the short term. And in the short term, the market's saying, hey, we're scared collectively, right? So we're going to get out of stocks, especially the growth ones. Well, those growth ones continue to see their prices go down. And I continue to see the companies, and it's been interesting to see some companies get closer and closer to a very good, value proposition to investors. As we look at, I'm not going to say Apple's quite there, but Microsoft's really given up a lot of gains. Nvidia's really dropped. I'm not quite there with Nvidia. I know that Google is discounted, and I just, it's kind of a mixed bag there. I'm a big Google stockholder, but when you look at Google's strategy, and they have to communicate that, hey, we're not going to go crazy in spending in the data center. That was my biggest problem with their earnings was, if they're going to spend a lot of capital and dry up free cash flow, it changes their valuation. And I hope they learned their lesson. Google's really sold off. That 8% year to date includes a rise in January. But if you look at the drop from all-time highs, we're in double-digit percentage, and it was quite a drop. Amazon's also feeling the pain. The big hyperscalers, Microsoft, Google, Amazon, they're feeling the pain. So hopefully they got the message. Don't overspend in the data center. So these prices, like I have Amazon right now fairly priced. Nvidia is still priced at a premium, but it's getting closer to fair price. Microsoft, I'm going to say, is still overpriced, but getting closer to fair value. Meta, I think, is trading at a discount. It was up 25% in 2025. Now it's only up, close to 7%. So it gave up a lot of gains, but it's still, Meta's sitting in a really desirable position in the market. They are spending too much in the data center, I would agree, but their growth prospects are massive. So I'm liking Meta. Berkshire, I don't have a lot to say there. That's more of an ETF like investment. And Broadcom is giving up a lot of their gains. I think Broadcom is severely overpriced. I think they benefited from the data center build out, and they rode the coattails of NVIDIA, frankly. And I think that Broadcom is going to be a money losing proposition for me, so I'm staying away from it. And FYI, as I've said before, hopefully I'm not sounding like a broken record, I invested in Broadcom. I made good money on Broadcom. So it's not like I hate the company. I just want to say bad things about them. I think it's a great company, but when great companies are priced way too high, it's just a reality. Stock price is too high for a great company. So that's what's going on. I think my attention continues to be in healthcare because healthcare is the number one sector. Healthcare should perform well no matter what happens with the economy. I think healthcare is going to do fine, especially since for the last couple of years, stocks have not really worked in healthcare. So the stock prices have a beginning point, not being too high. It's kind of like, hey, we got great fundamentals, dividends, great free cash flows, growth. And you see everything in healthcare. So I'm going with healthcare. I'm sticking to that plan. I'm buying healthcare probably the most in my portfolio. And so those are some opening comments. I've got some stocks that I want to take a look at, but I know that you guys always bring stocks that you guys want to look at. So let me take a look at the chat, see what's going on, see who's checking in. Doomy Trash, what's up, man? Android PC, good morning. Jay Zev, man, all the usual attendees are on. Thanks for joining. So Doomy Trash, you want to look at Trinity Capital. Put that on there. And then Omar, good to see you. And you have a question, which is, do I dollar cost average? The answer is yes. I dollar cost average, and kind of explain that a little more is healthcare is a good example. I'm dollar cost averaging into about 6 different stocks within healthcare. Those include Pfizer is the biggest position. I continue to buy into Pfizer, Catalyst Pharma, United Therapeutics. CVS has been a stupendous winner for me this year, and Elevance, and then the new kid on the block is Oscar Healthcare, and so just about every day, barring like if it's really having a great day, like stocks are really high, I may not DCA on that day, but other days I'm just buying into healthcare. I think it's going to continue to work. It's been working for me. I just want more capital in healthcare. So yes, I DCA, and that's the answer to your question. I'm not smart enough to know exactly at what point do I, make a big bet. So Jay Zev, what are the prices I would buy Meta, Google, Microsoft? Let me answer that, but I'm going to answer it. I'll show you my valuation that's based on free cash flows and earnings per share. And just a reminder, what's the type of investor that I am? I really believe in free cash flow, as Warren Buffett, Bill Ackman, Benjamin Graham, all the, I think the establishment call it, because it really is a true measure of a business's value. And I'm going to show that to you a little later. I'll show you all three. Deb Q, good morning. Genetic Smite, good afternoon. It is morning where I'm at, but I get that it's afternoon where you're at. Deb Q, Boston Scientific. That sounds interesting. I think it's tied to healthcare. It's like med device, instruments, that kind of thing. Got it. Rotel and Cheese, thoughts on Fresh Pet stock? Had a massive drop. Yeah, let's take a look. Fresh Pet is like a food company. I can tell you, I don't own companies that make food. And the thing that I don't like about companies like that, I put it on the list. They have terrible margins. I don't like restaurants. They have terrible margins. You have to buy ingredients. You have to prepare those ingredients. You have to hire a lot of people. It's just a long list of things that I don't like. So let me go through some stocks that I wanted to take a look at, and then we'll get into the stocks that you are looking at. So Adam T15, good afternoon from England. Lyft, yeah, let's talk about Lyft, man. I've been looking at Lyft this weekend, and I was looking at Lyft and Uber. So I'll give you the combo there. Thank you for joining. All right, so let's carry on. So the first stock I wanted to take a peek at is Cart. Symbol is Cart, Maple Bear. This is Instacart. This is where, if you want to order groceries, this is where you order them. And the stock I noticed was up this morning, so I wanted to try to start on a positive note since we got crummy expectations on stock prices. And these guys were up nicely, and I was curious to see what's going on. Year to date, this stock has sold off with the rest of them, right? I think February 19th was the day when a lot of these stocks started to sell off. I really like Maple Bear. It has a lot of the things that I like. So let me give you my first point, which is I like buying businesses that are desirable and really are businesses that I want to be an owner in. And when I look at Maple Bear, right? So the businesses that I want will have, the perfect ones are like monopoly-like. They have great barriers of entry, very few competitors, like if any. They're just so strong that they run their competitors out of the space, out of the industry. They have terrific margins, 80% margins. that kind of thing. They produce great free cash flow. And that's consistently, those companies end up at the top of the valuation of the stock market. So Maple Bear has a lot of those desirables. I'm going to come back to this. Let's go look at fundamentals, and then I'll place Maple Bear where I think it belongs on my desirability quadrant, whether it's really desirable in the green or if it's just a gray company, meaning it's a good business. Hey, it's a good business. If you get a good price, maybe I invest. And I stay away from the red, which is terrible businesses. And these are businesses that have very little margin. They don't increase value much over time. My goal is to grow wealth. My goal is to double a stock's value as quickly as I can. It's not to sit on a stock and make 20% over 5 years. That is a failure. That's not what I want to do. So let's get back to Maple Bear and take a look at my valuation. So when I look at Maple Bear, I like what I'm seeing when it comes to free cash flow. Based on its free cash flow, this business is discounted by 98%. That's a really high discount because of its cash flows. The true measure of a business's value is in the cash they can produce to put it on the balance sheet, buy back shares, acquire other businesses, do all kinds of things that they want to do, pay a dividend. And this business has great intrinsic value based on free cash. So I really like that about them. Let's take a look at their margins. So margins for Maple Bear, they're growing at 11%, and I would like to see them grow faster. They are smaller, and they're reducing. One thing they did recently is they reduced the minimum order so that they can get more volume through their platform. I think that's a good idea. Now, when we look at their gross margins, 75%. I like 75%, and they're small. And you notice how over time, as they get bigger, that margin is expanding because their scale. They have a scale advantage. Their focus, they really focus on grocery delivery. So their processes, their experience for their customer, all those things are optimized for the grocery store. Stability, like we're going to buy groceries. I ordered on Instacart yesterday. So it's a pretty good experience, and scheduled my grocery delivery. Food gets here. I, get fresh produce and all the things that I want. So it's a very, very good thing. All right. So where do I put, so first, I think they're discounted, terrific margins in the right space. I like the company, and I'm going to put them kind of saddling the gray and the green, not perfectly in the green, not all in the gray. I think they can continue to move to the green if they grow. If they grow, they move to the green. Okay. If they contract, they move to the gray because they don't have a perfect competitor. Right now, some of the competition is Walmart does delivery, they offer it for free, so does Costco. And those one-off kind of situations, I think, are not going to work for those organizations. I think Uber is a fine example, which is once people get very comfortable with the user experience, Instacart, maybe one day I want to order from a particular grocery store and the next day I want to order from another, right? Well, I just want one app. Instacart could be my super app for grocery or the things that I need for home, and that could be my app. So if they grow, that means that they're taking over market share from, Target, Walmart, Costco, who's trying to do it themselves. And if they contract, that means that, hey, it's not working. Walmart, Costco, they're doing better. Or maybe Uber comes into their space. Or maybe our friends at DoorDash are trying to creep into their space. Now, DoorDash has to be careful because they can try to do grocery and kind of alienate their primary customer, which is that food delivery customer. Maybe it doesn't disrupt that, but we'll see. So this business I really like. I really like Instacart. I've been buying their shares and will continue to do so. It's a smaller business. It's only a tiny market cap, 10.5 billion. So would I be surprised if a big business came in and said, "Hey, I want to acquire you, Instacart"? Nope. I'd be a happy camper because they'd probably say, "Hey, we're going to pay $60 a share for Instacart." And I'd be like, "Thank you very much. I'll take that." So Instacart is looking good. I'm going to keep buying shares and, continue to expand because I like the company. It fits the investing, type of company I want, fits that profile. It's in the desirability quadrant. They got to keep improving. You're too small to be, rest on your laurels. You have to keep growing. If they can increase their growth rate, that would be a good thing. All right, so that's the first one. Second one is a different situation. So Nike, I've been an investor in Nike, and I'm beginning to think to myself that the economy is not going to help Nike. You have the tariffs are coming up, right? So if you start charging tariffs on everything imported from China, that is not good for Nike. Not good at all. So I'm beginning to think, man, maybe I got to lessen the number of shares that I have in Nike. Now, I bought Nike because when I look at the stock and it sold off drastically, right? And I'm like, well, I'll take this number one category company. The brand is phenomenal, right? And I bought at a good rate. I'm making a tiny amount of money. Now, I'm not here to make a tiny amount of money. I'm here to double my money. And the things that are concerning, I think if I were to say, let's weigh the concerns versus the opportunity. Revenue growth. They're not growing. And when we look at their forecast, the forecast that, a lot of analysts cover the stock, 30 analysts, and collectively they're saying that we're going to have a pretty good contraction this year. And this year is going to end May 31st. So is the market going to be able to stomach the contraction? Maybe. But again, the environment for Nike is not getting easier. It's not like, oh, tariffs are going to make Nike's life easier. No, it's going to make it harder. If we're charging a duty on everything imported from China, that means the Nike shoes are going to be more expensive for Nike to procure. When they sell them, they're going to have less margin. So those things are a concern to me. Low growth, shrinking of margins. That's a problem for me. How am I going to expand the PE if these guys can't grow? And if their margins keep contracting, the PE is going to look worse. Let's take a look at let's look at Nike's valuation based on free cash flow, and that value is their 16% discount. Now I'm taking Nike's historic cash flow rates because I know they're going to bounce back. They will. But Nike's going to be kind of a slow grower. It's a safe stock. I mean, I don't think you can get in a lot of trouble buying Nike. So if the intent is, I'd be happy with Nike being up 50% over the next 5 years. That'd be a pretty good choice, but that's not what I'm after. The market's selling off stocks that look really interesting. Healthcare stocks, some of them are sold off. Some technology stocks are being sold off, especially small caps. So I want that capital so I can put it to good use. I want to put the money that I've got in Nike, and I want it to more than double over the next 2 to 3 years. So that's why I'm being critical of Nike. I don't expect a lot of growth. It's not a heavily discounted stock. So where do I put Nike on my, the desirability quadrant? Well, let's take a look. So when we look at Nike, there's some things that I really like about Nike. Now, one second. So Nike's brand is really desirable. There's only one Nike, only one, and they have such a dominant position. I like that. Do I like their margins? I'm not in love with their margins. Their margins are okay. It's an apparel company, right? It's not like Meta that's making 90%, margins because they don't really sell anything. They're just operating these platforms. So when we look at their margins here, it's 44%. It's not bad, but it's not great. It's not 85, it's 45. So I don't love their margins. Growth rate stinks, but they are the dominant player. So I put Nike kind of in the middle of the two quadrants here. And the last CEO did damage the company to some extent. He alienated some of the relationships they had with retailers that had been really important for Nike's success in the past. And now they have a CEO that's come in. I think he understands what's made Nike successful in the past. So he's going to make the company better. They need to grow. If they grow, they move more into the green. If they stay a slow grower, continue to kind of fade, become less relevant, then frankly, they'll be completely in the gray, because it'll just be like, hey, it was a storied company. Like many companies that were storied companies in the past, they just aren't that valuable anymore. So that's Nike. Now, what am I going to do with this stock? I think I'm going to start selling shares of Nike. I've already put a sell order on Nike, and it looks like the stock is about to open in the positive. I'm going to DCA my sale of Nike and put that capital in my cash pile, ready to buy some shares that are really being discounted. The market is selling off stocks quite dramatically, right? The futures are going to open lower. So it's going to be a negative day again. So that's what I'm doing with Nike. And wanted to cover that stock. All right. So another stock that is catching my attention is Robinhood. Robinhood is really feeling it because and it was down like 7% earlier this morning. So it's now only down 2.68. And it might be because the whole crypto, complex was really sold off this weekend. On Saturday, Sunday, Bitcoin was like near $80 per coin. And I think it's probably rallied back to some extent. Let's take a peek, see where crypto is trading. Yeah, Bitcoin's up to $82,612 per coin. So that is an increase. That looks a little better, but it was bad for a while. Over the weekend, it didn't look good. And Robinhood tends to trade with crypto because they do have a new part of their business where they're doing crypto. So that really helps them out. But I like that Robinhood is innovative. They don't copy what's done in the past and then try to copy it and do it better. No, they pretty much like to do things their way and really do it so that the customer desires it more. So zero cost trades, they do crypto, they're doing banking now. They have new products that are really exciting. And I really like their growth, right? Their growth has been really good, great growth. And they have good overall profitability. Profit margins are off the charts. Cash flow is positive. So all those things look good for me for Robinhood. Let's see what analysts are saying. So there's 15 analysts, and they think it's discounted by 38%. That's very good. Now, it was going up like a rocket ship for a while. Man, was it going up. And that was unrealistic, right? When we look at how the stock really rose, this is unrealistic. I knew it. It's like, okay, this stock has too much jet fuel, and the voting, stock market in the near term is a voting machine. Everybody thinks this thing's popular, and a lot of retail investors are buying into it. So I knew that it was going to settle down. It settled down quite dramatically. It's down 32%, but it's still a huge winner, right? Over the last year, it's up 163%. So it's still a really good stock for me. And I really like Robinhood. When I look at Robinhood, I put them in the green for a couple reasons. So I like that they make themselves different. They're constantly just staying different, staying ahead of the market. I mean, Robinhood in a lot of ways is making these old school companies that have been around forever, that have a lot of power, bend to Robinhood's ways. Free trades, crypto, banking, a lot of things that Robinhood's doing, they're unique and they're making everybody else adapt to the Robinhood business plan as opposed to Robinhood adapting to somebody else's. I like that about them. High growth, high margins, high profitability, high cash flow. Sign me up. I'm good buying into Robinhood and having a pretty good sized position of Robinhood. When I value the company and I look at Robinhood's valuation, I think they're discounted by 54%. That's a good discount on a stock that's already up 170% over 1 year, but it's pulled back 32%. So all things are lining to Robinhood's a good stock. So the Robinhood stock, I was not DCA buying into Robinhood because the stock had just gone off the charts. But I think I got to put green light on Robinhood and start buying into Robinhood because I think the discounts there. I love their business plan. I like their business. This is a green company. These are desirable business for me based on their valuation. Their free cash flow is excellent. And I think that this year isn't going to be great for the companies that depend on trade transactions, but it's a great year for a company that is very flexible and agile and can adapt to what's going to work this year. And Robinhood can adapt far faster than their competitors. So I really like that about them. So that's Robinhood. Great to cover a couple of stocks that I had in mind. Let me take a peek at the comments, and then we're going to start cracking on some of these stocks that you guys wanted to look at. All right, so Rotel and Cheese, gross margins 40%. Yeah, so I think we're going to cover that fresh pet food company, and we'll see that. Krishna, hey, thanks for the comment. That's really nice of you to say. Keep coming back. Starbucks. All right. Well, I'm having coffee this morning. That's part of the prep to cover Starbucks. I made money on Starbucks. We'll see where they're at. ABB or AB, dash versus grab. All right. So, yeah, we'll take a look at it. I was going to give you a couple comments just off the cuff, but I better not do that. Let me give you some quality comments with some real data, real fundamentals. Omar, you think energy will shine soon? Okay, I hope so. Energy, oil prices have to go up. Oil was pretty stable this morning, which was a surprise. And that will make oil companies go up. And if the stock market goes down a lot, but oil companies maintain their value, that'd be a positive. Omar, Salesforce is hard to take down. I agree. Salesforce is excellent. I've been buying the Salesforce. I like Salesforce. I'm going to buy more shares of Salesforce. I will show you my valuation of Salesforce a little later. All right, let's get cracking. Let's get moving. Before I check out the stocks you want to look at, the market has opened. What do you got for a stock market? Oh, not good. Not good in the neighborhood here. It's down 2.25%. Now, the S&P is up, no, down, excuse me, down 1.63. What is going on, stock market? Who angered the stock market gods and said and got them to sell off stocks so badly? That is not a good way to start the week. Not at all. Oh, man. Holy smokes. This is red all over. Well, that's not good. Man, that is not good. Not good at all. Looks like Meta, Google are down big. Amazon's down. Nvidia, Apple. I mean, it's pretty bad. Only positive is healthcare. Back to healthcare, man. These are continuing to work. Some of them, consumer staples, when everybody's afraid and they get out of growth stocks and they get into consumer staples that are safe. I'd rather go into bonds. And oil and gas. Omar, man, you might be right. Oil, big oil is working today. Cool. Looks good. Looks really good. All right. So let's take a look at some of these stocks you are interested in. And I think the first one was TRIN, Trinity Capital. Trinity Capital is a business development company specializing in term loans, equipment financing, private equity related investments. So lending on equipment, life sciences, warehouse lending. Okay. All right. And the stock for the past year is not getting it done, but it's been rising lately, which is quite impressive because financials have been selling off for like a week or two. So it's been kind of a bad situation for financials. And this one's doing quite well in the last year to date. Over the 5-year, this has not been a winner. So is it now a winner? Well, this has a big dividend. I don't invest on dividends, by the way. I'd rather see my stock price double in value, like the price itself goes up, versus, oh, you lured me in with a really attractive dividend. So this is a 12% dividend, and interesting. Okay, we'll take a look at that. It's a $1 billion company. Revenue at 226 million. Super low PE. They are growing really nicely. Look at that growth. Beautiful. Gross profit is all profit because it's financing. Okay. So I'm going to take a look at book value since these guys are a lender. Is their tangible book value is expanding fast. Look at that. That looks good. This looks really good. So that looks good. So really good really good revenue growth. Book value is expanding. Really profitable company. 4 analysts cover it, not a lot of analysts, and they're a little pessimistic on the company. What's their story? Well, they think the company is going to keep growing. Well, if you keep growing at those rates, I really like the company. And look at the PE, super low. This company looks really good. The one thing that I would be concerned about is, I talked about how the economy could be going into a recession. And if we have a recession, are these types of investments gonna go down? Is the volume of this type of investing and so forth, and businesses buying more equipment, developing more equipment, is that going to go down? Potentially. It potentially could. So that's one thing that you ought to take a look at. All right, so that's what these guys do. Now, I have historically not really invested in these types of companies because it feels like I'm investing into another investor who's making decisions on good quality businesses. Well, that's what I'm doing with my portfolio, and I do really well. So why would I hire somebody else in the form of Trinity in this case to make investments? So for me, it's not the right investment, but when I look at the fundamentals, this one looks really good. I can't argue with this one, other than just be aware that if we have a bad economy, it may limit the opportunities for Trinity Capital. So that would be the only comment I would put out there to the negative. All other things look pretty good. And I wonder why the market, with their growth rate, why isn't the market more excited? I get that the year to date, more recently, it's doing really well. So maybe it's beginning to catch on. So hopefully it continues on. Today it's down a little bit, but no big deal. All right, so that was Trinity. Let's go over BSX. Boston Scientific. So Boston Scientific Corporation develops, manufactures, markets medical devices for the use in various interventional medical specialties. Okay. Med device. So I said that I like healthcare. I don't have med device right now. I have pharmaceutical companies predominantly. I have some health insurance companies, and I have CVS, which is a combo company. So these guys, let's take a look at their revenue growth. Revenue has been good. And before I do that, let me look at their stock price. Over the past year, beautiful. 41%. Nice. Wow, real winner. Look at that. Up 41% in 1 year, over 5 years, 153%. That's what I'm talking about. This is the kind of business I want. I want a business that's just cranking, getting it done. None of this going up 10% over 5 years stuff. Show me some real numbers. All right, so we are going to take a look at their growth. Their growth looks good, 17% on a pretty big number, $16 billion in annual revenue. And then the last quarter was actually accelerating growth. Talk to me, Boston Scientific. I like what you got here. I like the fundamentals so far. Look at this free cash flow expanding. I like what you're dealing, Boston Scientific. So you're growing. Stock market knows who you are. It's been buying into your shares. The free cash flow is expanding really nicely. Gross margins, nice, 68%. This is med device. It's a device. They have to put materials and labor and so forth, inventory. So it shrinks their margins a little bit, but it's still really good. 67 is way better than Nike. Nike was at 45. So more money to be made in med device than athletic footwear. All right, so I'm liking what I'm seeing. So if I were to take their free cash flow number, which is $2.6 billion, I would probably say I'd like to pay 20 to 25 times that number. That gets me to 52 to, let's call it 65 billion in market cap. Okay. And when I look at their market cap, 141, whoa, it's way above what I think the cash flows are going to value the company at. So that's, the markets really like their business. And it's interesting that med device, this one here, has really worked. It's not my favorite category because you saw the margins. My favorite category within healthcare is more pharma because they make better margins. Boston Scientific, they have to make stuff. They have to have factories or have manufacturing partners that then take part of the margin. So this one is interesting. It's done really well. 22 analysts cover the stock and they think it's still discounted. This is on earnings per share. They expect that the company is going to keep growing nicely, growing 15% in 2025, and then 2026 they're going to have 10% growth. So the company is going to keep doing really well, but the PE is high. This one is a pass for me. I have better options within healthcare. This is already kind of like the stock's already priced for it to outperform. And it's priced so that they keep growing. They keep doing everything just right. If they have any kind of issue, this stock's going to sell off. And I think I could find better risk reward in healthcare right now. And I could find it in pharmaceutical, in biotech companies, and even CVS is working far better, and it has a better discount on the stock. It has a better proposition to an investor, risk reward. But thanks for asking. That was really, really good company. They've done well. All right, let's talk about Fresh Pet Food. So I think it was called Fresh Pet. These guys are doing a lot of commercials. Stock's down 5.45. over the last year, no bueno. Holy smokes. Man, it's selling off. It's a $4.46 billion market cap company. Revenue is almost $1 billion. Really high PE, even with this lower stock price. So let's take a look at growth. Growth looks good, 27%. Looking at the quarterly, it looks okay. It's slowing down a little bit, but nothing to be alarmed about. And so that's really good growth. Now, when we look at their gross margins, as expected, 40% gross margins. You see how they're growing their number a little bit, but I don't expect that they're going to get anywhere north of that because they're in an industry where if you're going to make fresh pet food, you have to buy ingredients. You have to, in essence, put value into that product that you then sell to your customer. So, okay, let's just be realistic. It's going to be a 40% gross margin business. And net profits are going to be low, single digits. Free cash flow is negative. Oh, but they're moving closer to being positive. This business is not for me. It's not for me because the lower margins, they just don't float my boat. The free cash flow being negative doesn't float my boat. I put these guys, it's an interesting category, but I actually put them, partially in the red. Why? They'll never be a high margin business. Okay, so that's strike number one. Competition. So the pet category has been kind of a category that's been working for food companies. And Freshpet's going to see competition from bigger food companies. These are human food companies that have a pet food kind of category as well. So they'll always be threatened by the bigger companies. Their stock has really been sold off. I think investors are worried. And this business, if they don't grow, if they stop growing, these guys are going to move into the red. Like, hey, low margins, no growth. If they can really become different, and maybe I don't know. I'm not a pet food kind of business analyst, but it just doesn't have the attributes that I want. I want something in the green. This is my target. Is let's operate in the green. Something that's going to expand value over time. So, pet food, Freshpet is not the right investment for me. I don't think the stock's going to work a whole lot in 2025. I think the market is not liking what they're seeing. So, good luck with that stock. Those are my comments on it. They don't pay a dividend, high PE, stock is not working. It's really sold off. Wow, that's painful. All right, so that was Freshpet. Now let's talk about Lyft. What's going on, Lyft? So Lyft's had some problems over the last 5 years. Man, it sold off. It was doing really well in 2021, and then it just sold off like crazy. But more recently, it's been showing signs of life. It's, if you buy at the right time, you can catch rallies on this. Now, why do I like Lyft? And I started to like Lyft is I'm a big Uber investor. I like the business. You're doing ride hailing, so you don't buy any cars, you don't hire any people. You basically operate the platform. So that's good. So let's take a look at fundamentals. Forward PE 11. Wow, that's a low PE. That's one positive. Growth rate 31%. Double positive. That's a nice combo. Forward PE of 11, super low, on a business that's growing 31%. That's a good combo. Very good. Margins. Gross margins, they're in ride hailing, 35%. Okay. Free cash flow, $766 million. Okay. Their market cap's $5 million. So you're getting on free cash flow, you're getting 13% free cash flow rate on their revenue. It's very good. So I really like their growth, the revenue growth looks really good. Their low valuation, PE is only 11. So that's a very good combo. Strategically, Lyft it's not as big and dominant as Uber. Uber is number one, but they do have a business that's working for them, especially in bigger cities. And they have this user base that likes Lyft. They use their platform. I think it could be an acquisition for one of these robo-taxi companies, or it could be a merger, or it could be an acquisition for one of these travel companies, like an Airbnb or Booking can acquire this business. They're only a $5 billion market cap company, and they can add more than $5 billion of revenue that is growing. So I think there's a lot of positive paths for Lyft. Now, I'm not betting a whole lot of capital on this one. I thought, it could really work for 2025 and put in a little bit of capital. That's my position in the stock. Let me show you my valuation of Lyft. So Lyft, just looking at their cash flows are going to be worth so much, 176% discount, or the cash flows are worth 176% more. If they keep growing, if they keep operating and doing what they're doing, the market in the near term is a voting machine. It's a popularity contest. It's how pretty you look today. Over the long term, it's a weighing machine. We're going to weigh your cash flows. We're going to weigh your profits. And holy smokes, at this rate, you're going to accumulate so much darn cash on that balance sheet. You already have $2 billion of cash with only $1 billion of debt. Pretty soon, you're going to have like $5 billion of cash on the balance sheet, and your market cap's going to be like $5 billion, which will be kind of nuts, right? It shouldn't. Right now, you really are looking at a $4 billion market cap company because they have in excess of $1 billion of cash on the balance sheet. So all those things to me are like, this is an obvious acquisition target. This business could be taken over by somebody and they get a pile of cash. They get a business that has a network, has a platform, has a customer base in a very desirable category right now, ride hailing. So I like Lyft. I think it's a pretty good play. Now, that's not replacing my Uber investment. I love Uber. I'm buying Uber stock. So Uber is one of my biggest positions in my portfolio, and I love the company. In fact, here's Uber now. And I think their cash flows are phenomenal. And why does a company like Uber and Lyft, why do they create so much darn cash? Well, think about it logically. How many cars do they have to buy? None. So they can double in size, not have to buy one car because the drivers buy the cars. How many employees in the field do they have to hire to give people rides? None. All these are contractors. They're gig economy workers that say, hey, I want to have my own little business. So I'm going to give rides on Uber. So all those things, I love that type of business. So Uber creates a lot of cash. Their market cap now is $158 billion. But the value of that cash that I expect in the future is going to be worth $318 billion. So I am betting big on Uber, have a big position. I'm betting small on Lyft just because I like Uber more. It's dominant. Uber is absolutely in the most desirable part of my quadrant. Uber is squarely in the center. They are number one player, dominant. They're so good. Lyft is tiny, and there's really nobody else. And when we talk about like Grab and other companies, first, Uber owns 20% of Grab, by the way. It's like, guys, Uber's so big that it's going to take a long time for another player to come in and erode their market share. And they keep getting bigger, and they're going into other categories like Uber does food delivery. I use the service. It's excellent. That platform keeps getting bigger. So their partnerships in robotaxi, they're going to partner with the different manufacturers of robotaxi, For example, Waymo, they're partnering with Waymo. I think they're going to operate in Austin and Atlanta. And internationally, they're partnering with the Chinese EV robotaxi manufacturers where they can have those platforms deployed in other parts of the world, like Abu Dhabi and other countries. So Uber is cleanly in the most desirable space that I have for companies. It's an excellent little business. Now it's a big business. So Uber is a really desirable business. I love Uber, and I'm going to keep investing in it. So that is Uber and Lyft. Somebody asked about it and wanted to give you that quick review. All right, Starbucks. And since we're going to cover Starbucks, let me take another drink of my coffee. I think that'll help me get ready to evaluate the leader in premium coffee restaurants. Now, these guys have had a rough year, especially sometimes. Now, the new CEO comes in with a lot of fanfare. And there is something that I would say that I agree with. If you asked, Warren Buffett's been asked, hey, is it super important to have, like, do you fall in love with executives, CEOs, and say, oh, no matter what business, that CEO is going to make it work, and I invest in a CEO? The answer is no. Warren Buffett's like, no. The inherent value of a business is the inherent value of the business. And a management team, although it's a good idea to have a very good qualified management team, it doesn't really affect the value of the business. If you put the CEO of Starbucks to run, let's say a cement manufacturer, I don't care. I don't care that you have a good CEO. It's still cement manufacturing. It's really costly, low margins, low growth, and very low valuations. So the CEO came over from Chipotle. He's coming over to Starbucks. I think a lot of people that invest in stocks, and I get it, everybody understands Starbucks. They go on and they pay $8 for a, Frappo macchiato with, almond milk and whipped cream with chocolate sprinkles. And next thing you know, you got $10, beverage. And you're like, wow, I should invest in this business, man. They're freaking clawing $10 out of my wallet. They're probably making a lot of money. So that type of logic really breaks down. It's not a good idea to just invest in businesses that you're familiar with in your community or maybe the products that you buy. We got to look at the fundamentals, because there's a lot of businesses that I frankly never buy products from, or maybe it's a product that I would rarely use, that have tremendous value, tremendous valuations, and I invest in them. Let's look at Starbucks. So this is a valuable business, 117 billion market cap, revenues 36 billion. Forward P is a little expensive, 33. This is a retailer. This is a restaurant, okay? Now, it's not like a restaurant that makes a bunch of food. They mostly do beverages, and they do have food items. But it's still a restaurant, which means it's a negative to me. Their growth, they don't have any growth. Okay, what the heck? You mean people don't want to pay $10 for a super deluxe coffee beverage? No. Now, if we go into a recession, that's going to get even harder. People are going to be like, hey, things are tight. Money may not be as good as it's been for the last couple of years. I'm not going to go to Starbucks as often. Maybe not at all. And I think that might be a problem. Over the last 4 quarters, negative growth. Not good. Now, so you have negative growth. This new CEO, he's come in and he's kind of said, hey, we're going to do all these, improvements and so forth. Got it. Show me growth. And then, my report card for the new CEO is very metric driven. I don't care if the guy sounds nice. I don't care if he looks good. I don't care about any of that. I don't care if he's interesting. He might be the most interesting guy in the world. I don't care. Show me fundamentals. I want to see good revenue growth, and I want to see your margins expand. Free cash flow is okay, but look, it was better in 2021. better than any other year. It was actually 2018 was the number one year. So this is kind of it's been declining, not good. We want to see it go the other way. So it's about a $3 billion market cap business. It's not growing. It's a premium brand. Maybe I pay 15 times this number, which would be about $45 billion. And the company's way north of that, like 118 billion, right? So this is really overpriced as a company. Gross margin is 26%. Come on. I can't work a whole lot with that. That means gross margins are not great. That means you have to hire a bunch of employees, lease out a bunch of expensive retail space. I mean, the list is long of the things that I don't like. I don't like all those cost things. It's a lot easier to be Meta and have this platform that people use their own personal PC or their phones to access, and then Meta just makes a bunch of money advertising on those platforms. It has great margins. Starbucks, on the other hand, they have to buy cups and coffee and train employees, and I mean the list is long on the cost items. So low margins, no growth, no thank you. Starbucks is a sell for me. It's, the company's been seeing a nice little rally because of the new CEO. Okay, popularity contest. The stock market in the short term is a popularity contest. It's a voting machine. Over the long term, we need to weigh the fundamentals. Low gross margins, free cash flow is contracting. If I look at the free cash flow and multiply it times 15, and that's a generous multiple because they're not growing. They haven't figured out how they're going to grow. I only get to like $45 billion of value. So Starbucks is a sell for me. I do not want it. A lot of people will buy it because they're familiar with it. Like, oh, I know what Starbucks is, and the CEO seems really cool and he sounds great. Combination, same thing with Chipotle. I like Chipotle. I eat there. I think the food's tasty and it's nutritious. Great. Especially when I'm in a hurry. You can always get a good burrito at Chipotle. When this guy was at Chipotle, the stock worked. I've never owned Chipotle. It's not the type of investment I want. Margins aren't good enough. So that's what I've got to say about Starbucks. Let's talk about DoorDash and Grab. Hold on a second. Hold on. Shadow Guy has made an appearance. I forgot this week where the U.S. springs forward. That's right, Shadow Guy. We don't like consistency. We like to confuse everyone, so we change the clocks. And we spring forward, which means everybody's kind of dragging today because we lost an hour of sleep. So good to see you. I hope you're having a good day. All right, so let's get back into it. We're going to go into DoorDash and Grab. Dash has been on fire and fuego. Up 34%, up 74%. Beautiful. And I thought they were doing better. I guess the pullback recently has really pulled the stock down. And see, this is what's good about corrections is, so I'm a fan of DoorDash. I like the company. I'm sure their valuation, and I think the business is great. I own the stock. I made some money on the stock. Great. Just the stock price was getting too high. Like, hey, this is a great business and all, but geez, stock market, you're really cranking up these stocks prices. Why don't you chill a little bit, man? I like seeing stocks go up, but not just go crazy. Like from September 10th until February 14th, the stock was up 70%. Then it settled down from that point to now it's down 17%. Okay, good. I'm glad the market's somewhat rational. In fact, if you measure from the low point, I invested in DoorDash here, and I ended up consolidating my capital into Uber, and I've recently bought into Lyft at a tiny position. But 110% from July 25th to February 18th, doubled in value. DoorDash is getting it done. Why is this stock valuable? Well, let's take a peek. Let's take a look. Let's see what's going on here. $74 billion market cap. Ford Piece 37. Now that seems a little expensive. 24% growth. Beautiful. Real nice growth. These guys really know food delivery, and they've got, I think, a customer base that really just this is their way. They don't cook. They don't like driving excessively. Maybe big city areas where you either got to walk 10 blocks to get to your favorite restaurant, or you got a parking situation, you got to take a subway and DoorDash, boom. Order something up, schedule it, have it delivered. You got good quality food. You're happy. You're busy. DoorDash is a really good solution. So all this is good. Good revenue growth. Let's take a look at margins. Free cash flow has been expanding beautifully. $2 billion in free cash flow. Nice. This is like a newer business, right? So for them to generate that kind of cash shows the value of this business, the intrinsic value of a business that can generate free cash. Margins, 49%, very good. They're in the food delivery business. Overall, so free cash flow margin, almost 19%. So at $2 billion, and I have a valuation on DoorDash, so I'm going to show that to you instead of taking a guess at what I would put DoorDash at. So DoorDash, I think, is fairly priced based on free cash flows, and it's priced 15% too high when I combine it with earnings per share. So it's fairly priced. And I showed you Uber. I'd rather own Uber. That's why I consolidated. I think Uber has bigger size, bigger scale, and is stickier. I think that Uber is growing their food category, food delivery category. DoorDash may see limits to their growth. It's a good business. They've done great. They've rewarded investors. But right now, it's just a pass for me. I sold DoorDash, so I guess it would be a sell. It's a great business. My hat's off to them. But I moved on, and I'm glad I did so. Stocks really pulled back. What has Uber been doing? Man, if I'm going to badmouth DoorDash and say Uber is the greatest thing since sliced bread, well, I guess they are doing pretty good, huh? Uber is up 22%. Okay. Uber, keep going up. Don't go down 3%. What's going on with the stock market? Holy smokes, man. What's going on here? Oh, man. NASDAQ is down 2.67. That is not good. So I think, we're not going to, we'll see where we close, but where I was going was, we're definitely in a correction of some sort, right? On the NASDAQ, we're down 11.7. And so stock prices are correcting. And when we look at the heat map, man, a lot of red. NVIDIA's down, Broadcom's down, Amazon's down, Google, Meta. Oof. And these are the big stocks, right? So again, healthcare, some parts of healthcare dodging bullets. Oil and gas, dodging traffic, running across a highway where the speed limit is 65. Consumer staples, utilities, a couple of the communication companies. So that's where you can duck for cover. Oof. Not good, man. All right, let's talk about Grab. So we're in the thick of ride hailing, food delivery. Pretty soon, we're never going to leave our homes. Everything's going to be delivered. We're going to have our robots with AI doing everything for us. Just have a nice recliner with my laptop, and I could trade my stocks. Woo. Although I like going outside. I'm a big outdoor guy. I like going for hikes and stuff. Holy smokes. Grab is really getting killed today. Down 7.5. Owie. Year to date, it's only down 10%. Most of it is today. 1 year, it's up. Now, this company is getting a lot of like attention. Market cap's 17 billion. Revenue is 2.8 billion. Forward P is 62. That's pretty high. When I look at their growth, 18%, which is kind of a, give you a sound effect. Wah, 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 meaning I'm not overly impressed. If you're tiny, why are people like going crazy about this company? They're little. Uber is humongous. They're growing at the same rate. Well, if you have the same percentage growth rate and you're tiny, that actually shows weakness. Why can't you grow faster? You should be able to grow much faster than Uber, but you can't, or you haven't been able to. So that is one of the things that I'm concerned about. Free cash flow positive. That looks really good. Gross margins right there with Uber and DoorDash. Okay. And these guys now, strategically, these guys are like in Asia. That's a good idea. Diversify into the Asia kind of economy. Makes sense. If I go 700 million at this growth rate, maybe it's international for me, higher risk. Maybe I pay 20 times their free cash flow rate. We get to 14 billion, they're at 17 billion. It's a sell for me. It's outside my home country, higher risk. I want a greater rate of return. They'd have to show me like at least a 50% discount on based on free cash flow valuation. So Grab is a sell, DoorDash is a sell, but they've done well, and Uber is a buy for me. That's how I stack things up in that space. Somebody asked about CRM. What's going on with Salesforce? What is going on? I think this stock is worth so much, and they've sold off. It's really discounted the stock. This is a forward P of 24. The business is growing at 8.7, but they're a huge business, $38 billion in overall revenue. It looks really good. These guys are setting themselves up to be a player in true AI applications. They have a really good portfolio of AI apps. And I think this is a desirable business for me. They're number one in their space. Nobody can compete with them in CRM, in Salesforce automation. In those types of businesses, it is Salesforce is the dominant player. They've been so good, they've run everybody else out of the space. Everybody else kind of tries to compete against them and they fail. And CRM keeps getting bigger and bigger and bigger. So good job, CRM. You're right in the space where I want to be. Now, do I get a discount if I buy CRM stock? Because the market in the short term is a voting machine. Over the long haul, it's going to weigh all this cash. This cash is like gold coins. You keep putting gold coins on that scale. It keeps showing a greater value. That cash is huge, and they keep making it bigger. It keeps growing the cash. So my forecast is that their cash is worth really, to me, $484 billion, but their market cap's 264. So there's a huge difference between the value of their cash and their current stock price. Buy. I am buying CRM because I think the market has this one wrong. In the short term, it's a voting machine. In the long term, it's going to weigh that cash. So I'm buying CRM stock. All right. Man, we got through a nice list of stocks there. A really nice list. Some people want to talk about Meta, Microsoft, and Google. So let's kind of hit that real quick. And I would share with you, let me share the valuations, kind of cut through the chase. We all know what those guys do. We'll start with our friends over at Microsoft. So Microsoft, right, one of the most valuable companies. And I think they're priced 9% too high right now. They really shrunk their cash. They're putting so much money in that darn data center that changes their valuation based on a cash flow forecast. And the market is sold off their stock. Their CEO has come out and said, wait, we're going to start leasing some stuff for the data center. It's not like we're going to go crazy with cash flow anymore. That was positive news. So they need to show an earnings where, hey, we mean it. Look at our cash flow, looks better. And then I think the valuation will change. So Microsoft right now is not a buy. It's a sell for me. It's just the valuation is not there yet. Google is discounted 34%, but their valuation went down because of the free cash flow. Now, Google sold off pretty good, and it didn't go up as their peers in the big, massive cap valuations. So this one looks good. This one looks good, and they have really good businesses like their robo-taxi business looks really exciting. So Google looks good. And the last one, you want to look at Meta. Two more, excuse me. So Meta looks really good. Meta's got it all together, man. Really good forward, possibilities with their AI business looks great. A lot of good things happening for Meta, and their core businesses are doing just fabulous. So this stock continues to be discounted. This is a buy for me. And now Amazon. So Amazon is fairly priced. I looked at Amazon earlier today, 3% discount, and they've really sold off. And Amazon has had kind of a peaks and valleys kind of last 18-month, graph. And if you buy at the right times, you can make money on Amazon. I certainly have. And so, but right now it's just fairly priced. Nothing really groundbreaking to report. Probably the best risk to reward situation is in Meta. That's the best one in my eyes. That's the one that I'm the biggest investor in. Meta is my biggest position. I love Meta and will have it in my portfolio. I don't own Microsoft. I own Google. I own Amazon. I sold Microsoft. I didn't like their earnings. I was so disappointed that I thought, I got to get out because they got to fix that. If they don't fix it, they're going to be on the pain train for a while. So, all right. So let me catch up. Hey, Tomas, how you doing, man? Big drops everywhere. I know, man. Isn't it crazy? So, well, hopefully discounts companies we want to be owners in. Shadow Guy, United Therapeutics. Is there one stock that's in the green today? Just one. Not asking for much. Beautiful. Look at that. Look at that. Nice. And this is I've been buying into United Therapeutics. It's been selling off. I don't understand why. This business has terrific growth. Let's look at margins. 89% gross margins. 89. Beautiful. Free cash flow. They have products where they're protected by patents. These products are being used by people that have these rare diseases that really need the United Therapeutics products. They continue to develop new products in their pipeline. So I really like this business. It's really worked along with Catalyst Pharma, and I'm now buying into Halo, Halo. So the healthcare space is, I think, the right place for me to invest. I'm going to buy shares in United Therapeutics today. I've been buying into this stock because the market, if you look at the 1 year, it's really kind of sold off over the last couple months. And I'm like, all right, stock market, you're out of your mind. And I'm going to buy the shares. And this stock's really worked. I mean, it's just a good company. Every time I look at it, I'm like, this is a sound business. I look at every single earnings report. I look at it multiple times in between earnings. Every time I look at it, I like it. So thanks for bringing it up, Shadow Guy. I needed a positive stock, and we got it. All right, let me catch up on comments here. Do me trash. And I cannot comment on Oracle, sorry. Sebastian Pacheco. Skull. Yeah, that's a good emoji for a day like this. J-Zab, ouch is the right expression. Virgin Galactic, aren't they bankrupt? Thought Virgin Galactic was bankrupt. So I never believed in this business, right? So these guys are trading for $3.20 a share, 90% loss for investors. Oh. So these guys wanted to make space travel. And what I saw, you get put into this little spacecraft and you basically touch space. I think you're up there for 5 minutes, I don't know, 15 minutes, and you experience space. Got it. But you pay like a boatload of money. And I'm like, I would never do that because it's super risky to ever try to get into space. In fact, Virgin Galactic lost a test pilot in their development journey. They lost a guy. He died. And I'm like, okay, there's going to be a bad event, right? Like it's just not ready. It's not safe enough for a guy like me to try it. Now, okay, so that's one thing. The price tag is another thing. How many people are going to want to take a flight of this type? I mean, there's a certain number of like really wealthy people. You have to be wealthy to take one of these flights, right? You know, so I just didn't believe in their business model. I'm like, okay, that's going to be kind of just a very narrow market. And their market cap now is 114 billion. They're losing money. I think they are in bankruptcy. They're growing a little bit. What are they? Are people taking these flights? Interesting. Oh, but look, oof, revenue is cratered. Yeah, this is not a situation I would want to get involved in. Don't like the business. The business is cratering. The market, in this case here, has it right, in my opinion. No, thank you. The one company that's been out there that I wanted to look at was a company that is in the space economy, and that's Planet Labs. What these guys did is they launched a bunch of satellites, and they basically are taking images of the world, and you can buy that data. So you could say, hey, I'm a farmer or maybe a big farming corporation, and we'd like to look at our fields. And so we want to buy the imagery for these particular GPS areas. And then they'll sell you that data or, a lot of different use cases. And these guys have been around for a while. They have really good data. $1 billion market cap company. They don't make any money. Net income, they're losing money. They are growing nicely. And do they have free cash flow? No, they burn cash. So these guys aren't ready for my investment. I think anybody that believes in them, this could be an acquisition because maybe like a Google would want to buy their data and add it on to Google in some way. That might be a possibility, but based on fundamentals, this is not investable. Most space companies are not investable for me. It's like, okay, I'm a big fan of space. I think it's cool what they're doing. But again, I don't invest in things that are cool that lose money. I'd rather be a fan of cool things and make money elsewhere. Even if it's a boring business, it makes a lot of money. Sign me up. The money spends the same. I'd rather make a bunch of money on a business that isn't all that cool. All right, so we went over that company, Virgin Galactic. SCHD is always green. Wow, look at that. So the Schwab US dividend equity, you might be right. And look at that, over 5 years. This is a winner. Yeah, looks good. Looks good. Can't argue with this one. This is a pretty good ETF. It's almost doubled in its value, and it's paid out a nice, well, I guess it includes the dividend payouts. So this is looking good. Yeah, good suggestion out there. Sebastian Pacheco, what are your forecasts for the S&P in 4 years from now? I don't have one. I think that the value of stocks will be higher in 4 years. I just don't. I don't. There's nothing for me to make. There's nothing for me to gain from doing that type of analysis. But in general, I think they're going to be higher. All right. So good to see you, Tomas, Junior, Pacheco. So you have a REIT that is Sila. So Sila Realty REITs, the REITs have been doing well lately. This one's doing well. It pays a nice dividend. REITs are good for income investors overall. This one hasn't been a winner over 5 years. It's only been, it's been around for a while. 1 year is doing well, 32%. Year to date, it's doing okay. And you get it paid a dividend. So that looks good. Okay. So yeah, I mean, dividends have been, real estate's been working. As you see, interest rates had been falling. When interest rates fall, real estate companies are going to do better because a lot of what they do to grow requires financing. So this one's not a bad idea. I own one REIT, CTRE. It's been doing great. I don't really touch it. It just sits there in the corner, makes money, and that's the way I like it. Shadow guy. You just reminded me. Oh, on CRM. So let's take a look at CRM. That's so the ratio that Shadow Guy's talking about is you want to add the growth rate and the profit margin, and it should exceed 40. So when we look at CRM, let's call it a 9, and then profit 16. So we're at 25. We're not quite at 40. Is that correct? So rule of 40. So the rule of 40 for SaaS company industry is a metric that suggests companies combined growth rate and profit margin should equal or exceed 40 to be considered financially healthy. Ooh, it doesn't pass that test. Profit margin is 16 and growth rate is, call it 9. So we're at 25. So we're falling short of that rule. Maybe a lot of investors are reading that rule and saying, we're not going to buy. So good point. All right. So cannot go wrong with O. I'm going to have a comment on that. So Omar, you want to look at Upwork? We can do that. So I don't like O. I think realty income. So dividends are good for investors that want income. Dividends are good. But Warren Buffett, I agree with him, is like he doesn't care about dividends. And he actually thinks dividends are tax inefficient, meaning when you get a dividend, that is ordinary income. And when you do your taxes, ordinary income, you have tiers of taxes, but long-term capital gains have a lower tax rate. That's what he means by being tax inefficient. So these guys here, realty income over the 1 year, not bad, 12%. Over the 5 year, terrible. So you're paying me a nice dividend and I'm losing money on appreciation. So that's not a good trade-off. I'd rather double my money on a stock that is like this. My computer is slow. I don't know if my internet is off, but basically, I'd rather own a stock that appreciates on stock value fast and gets me to 200% of the value of the money that I originally invested versus a company pays me 5% dividend. Well, 5% dividend is not going to make me much wealthier. But if you take a $50,000 investment like United Therapeutics, and over 5 years, you more than tripled my money. I gave you 50, you give me 150 back. Yeah, now we're talking. Now we're talking. That's what I'm looking for. I'm not looking for dividends. I don't care about dividends. You give me 250% return over 5 years, I'm good. I'm more than good. I'm happy. I'm wealthier. So that's why be careful with dividend stocks. Dividend stocks are a favorite to many investors because it's easy to understand. Hey, this stock pays 2% dividend. Well, this other stock pays 4% dividend. Well, the 4% dividend one looks a lot better. Yeah, but it's just a number. The value of the business is what we should be looking at. We want 250% rate of return. We don't want 5% or 4%. That's not going to do much for me. So just be careful. Okay. I'd rather you make 250% rate of return over 5 years as opposed to 4% at a time. All right. So we got through the list, man. Oh, we got Upwork. Man, Upwork. So Upwork is in the right category of businesses. These guys are managing the gig economy for people that want to gig versus, maybe they have a full-time job, but they do stuff on the side, or maybe they need flexibility, so they want to do gigs. And Upwork provides that type of platform for companies to find people that can do certain tasks or get certain things done. I think it's brilliant. They are growing nicely, 11%. I'd like to see them grow faster. And they are profitable, cash flow generating. Those things look really good. So I like Upwork. I've been buying into Upwork. I have a buy on Upwork. I like their uniqueness in business model. You think about, does gig economy make sense in the current year? Absolutely. People can work remotely all the time. I actually think there's a phenomenal discount on this business because they're already generating cash. They're growing. They don't have debt. If you look at more cash than debt, so this business is worth a lot more than where they're currently trading at. So I really like Upwork. Thanks for asking about Upwork. All right. Well, this stock market is not going in the right direction. It is down 3%. What the heck, stock market? What the heck? Man, ugly, brutal. Broadcom's down. Apple's down. Palantir's down. Oh, man, my good friend Shadow Guy. Sorry about that. Google's down. Oh, well, there's my biggest position in my portfolio. Man, geez. Somebody get me a tissue. I'm going to start crying. So we got some parts of healthcare are still. Lilly's been selling off, maybe because the Novo Nordisk news is taking them down as well. But there's some green here. Energy's doing well. Chevron's holding their own. I got paid a big dividend on Chevron, and I'm feeling good about that stock today. And consumer staples are good. Utilities are still in the green. Man, what a brutal day. What a brutal day. Oh, man, I should have stayed in bed. All right, so let's see. What sector is making it happen today? Come on, stock analysis. Give me some percentages on the first column, please. Sometimes it does this. Stock analysis is awesome. I love their format, but here's the one-day change. Sorry. So energy, staples, utilities, real estate, industrials, healthcare is here. Technology is getting beat up. consumer communication services, which is Meta and Google, they're getting hammered. Oh, man, brutal. Financials are down. Oof. Man, the big stocks are selling off. Man, look at that. So Apple sold off, Microsoft, Nvidia, Amazon, Alphabet. Okay. Man, everything's red. Nothing green in the top most valuable companies, which is why we're seeing these indexes sell the index is down so much is the most valuable stocks have sold off so much today. So that's what's going on there. All right, everybody. Oh, Mike, the dividend investor guy, making an appearance. How you doing, sir? And then, so I'm going to look at Zscaler. Take a look at that. Oh no. Zscaler down big time. Zscaler is doing well. They just had their earnings, 6%. Okay. But you see, it's still up for year to date. They had really good earnings. Just everything's getting shellacked, and this is a smaller cap. So I'm going to buy more Zscaler today. There's no new news. Yeah. But their earnings were really good growth, profitability's there, cash flow's there. Now let's test the law of 40, right? Or the rule of 40. 27% growth. What's their profit? So their profit is negative. So that one doesn't pass the 40. So this is a SaaS company. So man, 2 stocks not passing the rule of 40. So yeah, Zscaler to me is a buy. It's still discounted nicely. It's had really good earnings. And out of the cybersecurity stocks, this one is the one that I have decided to buy. 76% discount on their cash flows, overall 40% discount overall. So I'm good with that one. I think somebody wanted to. So AppLovin has dropped so much that they now, in my opinion, are discounted. I did a video on it. Holy smokes. Man. That is a big drop from that makes it so AppLovin is now discounted. And with today's drop, that's a pretty substantial discount from the high to where they're at now, 52% drop. Wow. And when I just did a video on AppLovin yesterday and I updated all my analysis, and I think I ended up buying AppLovin today because I put a buy order on it and they dropped big time. I didn't thought they dropped 10%. But here we are. I think they're discounted by 29%. And this is a really good business. Their stock price got too valuable, too high price, too fast. 300% rate of return. That's just nuts. It's like insane. And the market cap's $81 billion. So now they've really pulled back good. They deserve some of this rise, but not 300%. And it was actually higher. That's 300% after the pullback. When you look at before the pullback, they were up 639% in a matter of months. Nope, that's wrong. That's wrong. Stock market got crazy. Now it's pulling back. It's probably going crazy the reverse way, right? It's probably just now pulling back so darn fast, it's probably going to pull back past their intrinsic value. So it looks like I am an AppLovin stockholder because I put a buy order. I lowered the buy price, but I'm fairly certain that I ended up buying shares. Let me take a quick peek. I think I can look at it real quick. Nope, I'm locked out. Man, it is not looking good for me. My portfolio's getting shellacked. Yeah, I am an app stockholder now, and I bought it close to that low. All right, we'll see where we go. Perfect. Thanks for asking. All right, so I think we're rounding third and we're heading for home. Let's see here. Mike, the dividend investor guy. You got some more good news for me? That's what I want to hear. Good news on ELF, Elevance, and LMT, which is Lockheed Martin. So ELF is the beauty company, right? That looks great. What happened? That looks awesome. Great. And then Elevance Healthcare. Let's head for cover. Let's all get on our foxholes until the stock market isn't so darn angry. That looks good. That's one of my stocks. Good to see that. And then LMT. I mean, LMT is kind of a safe stock as well. Lockheed Martin. Yeah, man, that looks good. All right. Thanks for showing up, Mike. Good to see you. And I think that's it. Cool. All right. Thanks for we'll end on a positive note. All right, guys. I'm glad I had a chance to stream. This week I'm kind of limited and I'm currently traveling, so I wanted to stream if I could. And I apologize, I couldn't have the paid investor call yesterday because I was in the middle of something. But if you need anything, you know where to get a hold of me over on Discord, or if you want to message me directly, that'd be great. And if you want to be a paid member, I would appreciate that. Consider it. Would appreciate your support. I'll invite you to the investor only calls that we have, as well as kind of give you more information out of my portfolio and my analysis that I hold. So consider that if you could. The details are on the details of the stream as well as on my channel. You can take a look at that or you can ask me. So everybody, good luck today. Keep your head up. Let's just kind of know that, hey, the glass is always half full. If you're going to discount some of these stocks, like I bought AppLovin today, that thing was dropping, and now I'm an AppLovin stockholder. It's a terrific business. And maybe some of these other stocks are dropping into that buy zone. Meta looked pretty damn good. NVIDIA keeps dropping. What's the stock price on NVIDIA? Because NVIDIA has dropped $107 a share. Oh my gosh. Man, that's a big drop. PE forward P at 24. Oh man. What's NVIDIA priced at right now? So let me look at my valuation here. So right now NVIDIA is priced a little too expensively. I think my price target's $91. So still has a little bit of ways to go before it gets to fair price. But interesting how things have played out. This stock is kind of, you're an NVIDIA stockholder, it's got to be a really uncomfortable zone. It hasn't done all that great. The 1 year is now down to 23. This used to be an absolute darling for the market, and it still is. Awesome company. Robinhood is way down. Oh man, what's going on, Robinhood? I expected that, by the way. Oh man. Well, today's going to be a day when I buy some shares. And hopefully I put a sell order on Nike and it probably triggered. I'm going to have to go catch up on my trades. All right, everybody. Awesome stream. Thanks so much. Thanks so much for attending, for all the really good questions. We covered 2, 4, 6, 8, 10, 12, 14, 16, 18, 20 stocks on this stream. And we also observed a big sell-off in the market. So let's keep our fingers crossed. For all we know, it reverses middle of the day like it did Friday. I hope it does. If anything, just to like lessen the loss. But I think it's going to be a good buying day. I'm going to go bargain hunting and see if I can find a few bargains out there. Everybody have a terrific Monday. Have a great week. Keep your head up. Let's go find some good value out there. Take care.